Hi, and welcome back to ABG's Investor Days. My name is Lara Matadi, and I work as an equity research analyst here at ABG. With me today, I have Jonas Tunestål, CEO of Scandi Standard, who will be giving a short presentation of the company, followed by a shorter Q&A. Please go ahead, Jonas.
Thank you very much. I'm glad to be here to present Scandi Standard and also a couple of our quarter one numbers and figures. So I will start directly. Scandi Standard, we are a pure chicken player. We have 13 billion in net sales, and we serve about 1 billion meals a year. And we are approximately 3,200 employees, and we are present in 5 countries, in the Nordic and in Ireland. And there are strong consumer preference for local produce, so therefore we have local footprint in each of our country. But we work as one team together, as we call. We have these 5 P&Ls and 1 Scandi Standard, and that is to be able to be local and present in the local market, but at the same time use the effects of being a group. In quarter one, we have some significant volume and profit growth. We see strong demand at slightly lower prices, but our prices are direct linked to our input costs. That is an important thing to understand when you look at our numbers. Our top line is linked to the feed cost in the chicken production. So you have seen in this quarter, you have seen strong growth in volume, you have seen strong growth in margins, and you have seen strong growth in our EBIT. But our top line is slightly declining due to that link. And that link is about 80% of our businesses have this link to the feed price. We have this EBIT of 122 million, that is 30% increase compared to last year, and it is in our ready-to-cook business that we see our strongest improvement. In our ready-to-eat business, for the ones of you that have followed us, we have this temporary lower capacity utilization due to we lost that big contract, but we are regaining and recovering volumes, but I will get back to that later. We see we have a strong balance sheet and put ourselves in a position where we're strengthened that the latest years to be able to take next step in Scandi Standard. And our dividend is 2.30 SEK, and we have already paid the first half a couple of days ago. Scandi Standard has made this successful turnaround process. When you look at more long-term in Scandi Standard, you see this high organic growth from 2016 and stable margins, about 4%. But then in 2020, in the first half, came this COVID-19 disruptions and also an unsuccessful differentiation strategy in Denmark that cost Scandi Standard a lot. As you can see, that dip in margin happened during that time. But since then, we have had a successful turnaround process, and we took down the volume, set up the prices, and made a new strategy in Denmark, and has come back since then and recovered our margins back to historical levels. And when you look at fixed EBIT, we are in this quarter actually the strongest EBIT in Scandi Standard's history. And now with this strong demand, we allowed ourselves to put up the volume back again. And the reason why we see this strong even demand in chicken is this because it is an affordable product. Even in the high-end cuts in chicken, they are competitive to the low-end cuts in other proteins. And that means 2 things. It is about the competitiveness in chicken, but it also allows us in the long term to actually be able to increase the margins over time. And here you can see where we are present and our market position in the different countries. We are number 1 in 3 countries, and we're actually number 1, number 2 in Denmark. We are 2 equal players there, and then we are have a more challenger position in Finland, where we are number 3. And as I said before, we have this local footprint in every country, and the country on the customer base, and in our competitors, we are highly consolidated, so there are only a few players. And there are also high entry barriers to be able to enter the market in terms of the high preference for local produce, and you need a lot of capex to be able to set up a slaughterhouse, and you also have a long lead time to invest in farming and so on to get your local position in a country. So in some sort of way, it's a little bit semi-closed and this, because of this large hurdle for new entrants. We are also expecting strong growth for the future. We have seen historically 44% poultry growth since 2010, and we're expecting a 13% growth from now on until 2030. And as you can see, we are the only protein that are growing over time. And that even if you compare in 2023 and go look into plant-based, or if you look into the other red meats like pork and beef, chicken is the only one that is growing. And we think that these are the growth drivers for that, because we have the responsible, safe and nutritious part of chicken seen as a healthy protein, but it's also convenient and versatile. And what do we mean with that? We do not have any religious barriers. We also see that in the convenience business, we see a strong growth in chicken when it comes to salads, when you see chicken kebab or nuggets or burgers and so on. So it's you can use it in many different occasions. And then you have the affordability, and we call it affordable because it's sustainable, and that is due to the high efficiency there are in a chicken. It's actually, when you look at the CO2 emissions and the feed conversion, it's beneath both all the other meats, and it's beneath salmon as well. And if we can make a good progress in the feed when it comes to soy and so on, I think that we can be down at a level at some plant-based products as well. And here's a reconciliation of our segments. And as you can see, we have this strong growth in ready-to-cook in the quarter. We are a little bit more challenged in ready-to-eat than others, but that's short-term challenge, and I will get back to that. And if we go a stick deeper in the ready-to-cook business, we see, even though I explained the link to feed prices and the lowering of input cost, we have a 3% increase in net sales, and we have an 8% increase in volume, and we are moving from 31 million in EBIT last year into 96 million now. We see that this is a continuous strong improvement in earnings, and we see that that will continue in terms of the demand is rather high for the future. But with that said, when we're looking into our EBIT per kilo, because that is a thing that we want to measure how much profitability we can take out of every kilo that we produce. We have recovered, and due to last first quarter, we are now at 137 compared to 0.47 last year. We still have a gap to close, as you can see in the top right corner. And when we're looking at our total profitability in Scandi Standard and our financial targets that we have set up, we are aiming for 3 kronor per kilo in Scandi Standard in total. So we have a way to go, and we have a firm plan to reach that. We also see that the export prices remain at high level, and that is due to lower supply in Europe, and we will see supply constraints in Europe in total, and that will keep the export prices on a high level in the nearest future as well. And then when we come to ready-to-eat, there we have this net sales drop and our EBIT drop from 45 million last year to 25 million, and that is due to the loss of that contract. A big contract that we have had And now we are recovering the volume and getting them back. And actually, we're replacing the volumes with a more diversified portfolio with higher margins on each contract. But it will take a little time to get that back. And at that time, on that journey, we have, of course, a higher cost price, and that has cost on the EBIT level. And here you can see the net sales in ready-to-eat over time. And at the top right corner, you can see we were in 2023 down to 600, and compared to last year. And in this quarter, we're down to 594. It ended out at the lowest volume in Q4, and that was also what we communicated. And then we will take step by step for each quarter. So the quarter one were higher than quarter four, and we're aiming to continue that process and have Farre, that is our biggest ready-to-eat plant, filled up, because we see a strong growth over time. It's uneven, and you can see that in historical numbers as well, but it's a strong growth, and that is due to the strong convenience trend. And that is And here you can see our net sales over time in ready-to-eat. And as you can see, we had this top in 2019, and then a short dip, and then we climbed again. And when we look into our cash flow guidance, we are expecting to invest 500 million in CapEx this year. And that is an expansion of our ready-to-eat plant in Norway, where we have capacity constraints and actually are sold out at the moment. And we are putting up that plant during this summer, and hopefully it can give in production in quarter four. We're also investing a lot in deboning capacity on legs. We see that a massive trend all around Europe to consume more deboned thighs and legs. You have had that in Sweden for a while. We're also increasing our product differentiation in Ireland, and we are investing in a new ERP system. That's a project that we have been working on for years, and the first go live were in Sweden, now in Kronfågel, a couple of weeks ago, and then we are rolling it out in Norway and Denmark and the rest of the countries during the years. And it's super important for us to ensure the animal welfare. That's a cornerstone for us in Scandi Standard, and to be able to be a leading player. We are well ahead of this in the Nordic, but for that we are on forefront, we can be even better. So this is a cornerstone in responsible animal welfare and safety for consumers and employees, and the nutritious part in chicken as well. And we are measuring it in a structured way. So we have this ESG ratings, as you can see on the right side, and I think that we are on number 10 out of 360 worldwide in packaged foods. And when you look at on the top on the CDP, I think that A-, when you look at in Sweden, I think that we're only two companies in the food industry that have been able to receive A- in the CDP rating, in the ESG ratings. So we are moving really, really much up this area, and this is a big focus from us. And this is the strategy, our simple four pillars that we need to be excellent to actually be able to increase our margins and increase our profitability and be a future-proof Scandi Standard. It's about increase the value of our protein, ramp up the efficiency, have sustainability as an integrated part in our total business, and working as better together. And this is the one Scandi Standard that I'm talking about. That we can be these 5 P&Ls with responsibility, but we're working and excel as one team. And the most valuable part in terms of EBIT, it is about increased value of our protein. And this is the special thing with our business. It is that we buy in a whole piece and put that into pieces. Most other businesses buy components and build a product. And when you have this type of reversed value chain, you need to optimize everything because it's given what you get. And then you need to optimize it in the best way, both on a sustainability means and on a profitability means. And that's why we have put up this financial targets. And they are really important for us, that it's both targets on sustainability and it targets financial targets. And we are expecting a 5 to 7% organic net sales growth. As I explained in the beginning, it will go a little bit like this due to the price of the input costs. But organic growth of this time will be 5 to 7%. We will try to achieve an EBIT that is above 6% and a ROCE that is above 15%. Then we'll reduce our CO2 emissions with 50% and have this low antibiotic use that is unique for the Nordic, that is beneath 1%, and lost time injuries beneath 15, and this employee satisfaction above 75. That is also something that we measure. And then we have this target that we're also talking about, this achieving this 3 SEK per kilo. And that is our most important internal target, because that measures how much value we can get out of every kilo that we produce. And we are in Q1 2024 at 1.74, and we're going to we are aiming for achieve above 3 kronor per kilo. And then maybe the question is, okay, where have you found this 3 SEK per kilo? Is it realistic? It's absolutely realistic. We know that the good ones in Europe are well above 3 SEK per kilos. And we have, with this unique position, and if we're able to optimize Scandi in a really good way, we can achieve that target and go beyond that. Oh, sorry. But we need to invest, so we have this investment, 2 billion investment program, where we earmarked part of that as sustainability, to meet our sustainability target. But that's the same thing. That's the same thing as efficiency. It's about using fewer resources. So to summarize this presentation, we see in Q1 significant profit and margin expansion. We see an encouraging demand. We are expecting continued profitability in our ready-to-cook. We have a strong focus and a disciplined replacement in ready-to-eat. And we have a clear strategy to reach our long-term goals. So we have building blocks to actually be able to get beyond 6% margin and beyond those 3 SEK per kilo. And we see a large potential of climbing the value ladder. We are calling it internally the chicken ladder, where we actually try to focus and take out most value of everything. It's not only about the breast fillet or the legs or the wings. It's also about how you can take most profitability out of the feathers or the manure or the intestines, and how you can move things up the value ladder and take out most value out of it. Because 50% of the volume on a chicken is things that are not main cuts. So that is super important for us, and that's why we have put out this, as we call, the ingredients business. So that's the final words in the presentation.
Thank you, Jonas, for a great presentation. Maybe we could start off with a couple of high-level questions regarding the attractiveness of chicken as a protein.
Yeah.
Could you, as you mentioned, chicken is growing, but could you elaborate a bit on how the relative attractiveness of chicken has changed versus other proteins, and which key consumer trends are driving this?
Yeah. Yeah, a little bit like I said in one slide. I think that there are a long-term trend, actually, and that is a movement from pork into chicken, and that has been going for a really long time. And the reason why, there's those several reasons. It is because it's affordable. We need to remind us on that. It is an affordable product because it is sustainable. So it's high efficient protein. Everyone can eat it. There are no religious barriers or so on. So you can serve it everywhere. It is also a protein that is versatile in that meaning that you can use it in many different species. So when you look at ready-to-eat or convenient food, you can see it in salads, you can see it in sandwiches, you can see it in nuggets or burgers, or you can see it in the frozen segments in chicken kebab and so on. So it's a really broad spectrum in convenience, and that is one of the main reasons for the growth in chicken.
Yeah, thank you. And if we turn to the development in your key segments, I'd first like to ask some questions on your ready-to-cook segment. Mm-hmm. You know that 2023 was a year of recovery for ready-to-cook, and in Denmark, now that you've reached break-even results, could you share some thoughts on what we should expect in the near term and in continued improvements in the near term?
Yeah, if we take ready-to-cook in general, we see this, as we say, continuous growth. When it comes to Denmark in specific, there were this drastic strategic movement that was really costly for Scandi Standard that was made a couple of years ago. Now when we have reversed that and balanced that in a good way, we have got back to break even in Denmark. We have this aim in total in Scandi Standard of an EBIT margin of 6%. I think that Denmark will be able to support that. It will not be the highest margin in our group, but I really see good traction in Denmark, and I really see that we are able to move that significantly over time. So we have a positive outlook for ready-to-cook in total and Denmark moving up.
Yeah, and in Sweden, which has historically been your biggest market in this segment, volumes have reduced. Can you share some thoughts on when you expect Sweden to return to volume growth?
Yeah, actually we are at that stage. We took down the volume to secure the price level, and that is the good thing with chicken compared to other proteins. We have this short production cycle, so we can scale down when we see that we need to put prices through when there are high input costs as the feed prices. So we took the volumes down and actually set the prices up because we knew that there are continuous growth in the poultry segment. And now we see that we're slowly picking the volumes up in total and also so in Sweden. But we have capacity left, so we have room for growth in the coming future.
Okay, and with that, I would like to thank you so much, James, for your time.
Thank you.